Hello and welcome to the ISDA AGM studio. I'm joined by Emmanuel Ramambason, who's Financial Markets Global Head of Resource Management and Analytics at Standard Chartered Bank. Emmanuel, thank you for joining me today and thank you for speaking at the AGM earlier.
Glad to be here. Thanks, Mark.
So we've seen a number of liquidity crunches in the markets over recent years, starting with the dash for cash in March 2020 and also the turmoil in the UK gilts market in September last year. To what extent do you think the measures taken to mitigate counterparty credit risk have increased vulnerability to liquidity risk?
Well, I think that if you look at the rules that now banks are constrained with, particularly the GSIB banks, it's evident that our ability to intermediate at times of stress is diminished. The constraints we have on the balance sheet are material and are driven in part by typically the leverage ratio, the LCR, the NSFR rules. We're maintaining larger liquidity buffers in times of unstress so that we are better positioned if stress comes. But when the stress comes, because of all of those buffers that we have to maintain, we are far less able to step in the market and intermediate and take in some of the stress in between clients and give them the liquidity and typically the ability to monetize their positions that they so dearly need. So I think in the recent events, what we have indeed seen is banks have stepped in, but banks could not step in as much as needed. And in the end, central banks had to come in to help the market find the liquidity that the dealers could not supply in the required quantities.
So how do you think policymakers could respond to reduce these liquidity issues whilst maintaining financial stability in the markets?
Obviously, financial stability is paramount. What I think regulators should do collectively with the banks and public and private sectors together is really to test the different rules that are in place and see how misaligned some of them are and really look for unintended consequences to try and really realign them at two levels. One is in terms of content. So what are the eligible criteria that typically come in the math and how those rules are calculated. So there is room, we think, there for things to be adapted. And then there is also an alignment between the different rules. Some of them go east, some of them go west. I mean, the idea would be that we keep the stability focus, of course, but that we bring all of those rules into a more consistent approach that give us the right outcome and hence make the whole process more efficient and would allow then, I think, banks to be in a better position to supply intermediation at times of stress.
Okay, thank you very much and I hope you enjoy the rest of the AGM.
Thanks, Mark. Pleasure.